In today's video, I will be going over how to read a company's income statement. This is crucial for investing because you need to be able to do the necessary research on a company to see how financially healthy they are before you can invest in them. But before we get to the video, I just wanted to apologize for not uploading a ton recently. I actually had surgery last Thursday on my arm, and so I've been recovering from that. And so for the next couple weeks, my uploads might be a little bit less frequent than previously, just as I recover, because I can't use my right arm or anything like that, so I apologize for that, but let's get right into the video. So the first part of the income statement is sales and other operating revenues. So this is pretty much the total money that the company brings in. So this income statement is from LyondellBasell Industries. So this is going to be the money that they receive total for the sale of their plastics and products like that. So this doesn't factor in any expenses or anything along those lines. It just is the total amount of money that they brought in each quarter, and then it also has a yearly total. So what you're going to want to look for in this is just steady growth, or depending on the company, maybe fast growth. Just any growth is the main thing that you're going to want to look for in revenue from the previous year and previous quarters, so that the company is still strong and growing. And if revenue is going down, it doesn't necessarily mean that you shouldn't invest in the company, but you should figure out why it's going down and whether or not it's going to be a permanent decrease or whether it is something temporary. And so it just kind of lets you know how the company is doing in general. And this is often referred to as top line. So if you hear that a company grew its top line by 5%, that would mean that they grew their revenue by 5%. So the next part of the income statement is the cost of sales. And the cost of sales are the direct costs that can be attributed to the production of what the company sells. So this includes things like the cost of the materials used. So for LyondellBasell's cost, this is the cost of whatever petroleum they use to manufacture the plastics and things like that. This cost also includes labor costs that are associated with the production of the goods. So general and administrative expenses pertain to operation expenses rather than expenses that can be directly related to the production of the company's goods. So these are things like rent, utilities, insurance, and managerial salaries, instead of things like the cost of materials that they're using to build their products. And the next part of the income statement is research and development expenses. So this is just how much money the company is putting into research for new products or more efficient ways to make their products, things like that. So just anything that's going into research or development for them. This is often a large expense for biotech companies and pharmaceutical companies because they're constantly researching new drugs. And so you want to see if it's a company like that they're researching and developing new products and stuff. It's kind of showing what they are investing in their future. So the next part of the income statement is the company's operating income. So this is pretty much their revenue minus the cost of sales and the general and administrative expenses, as well as the research and development. And so this just lets you know how much money the company is making after subtracting out all of their operating expenses. So the next thing is income from equity investments, which is pretty much income from like stocks and things like that. So if they're investing in other companies, that could be what that is on a balance sheet. Interest expenses is how much money the company is paying in interest on its debt. So this is important to watch out for because you want to make sure that the interest expenses from debt are not swamping the company and really stifling growth. If interest expenses grow too large, they could be taking up large shares of the company's profit, and this could be a problem for the company. So it's really important to make sure that these numbers are not too high when you compare them with the company's operating income and net income. So this one's pretty self-explanatory. It's pretty much just any income that the company gets from other sources that are not listed here. They put this under other income, and then if it is in parentheses, that means that it is a loss. That is normally the general rule of thumb for a income statement. If it's in parentheses, it is a loss. If it is not in parentheses, it is a gain. So income from continuing operations before taxes takes their operating income and adds in income from equity investments and other income, and then subtracts out their interest expense. So this is a good picture of how much money the company is making before they have to pay their taxes. So you can look at this number if you think that the tax rate is going to change for a company. Then you could see how much money they're making before taxes and calculate what the effect of a tax change would be. It's also just nice to see how much money they are making before they pay their taxes. Then provisions for income taxes are how much the company is forced to pay in income taxes. So this goes to the government and is subtracted from the company's income that would be given to shareholders. So this is pretty self-explanatory. It's just how much money the company has to pay in taxes. So income from continuing operations takes the income from continuing operations before income taxes and takes out the income taxes. So this pretty much just tells you what the company has made after they've paid all of their taxes and have taken out other expenses and things like that. So loss from discontinued operations net of tax, I think, is just the losses that they took that they weren't able to use for tax deductions and things like that. So this is relatively small on their balance sheet, so it's not having a very large effect on their income, but this is just taken out of the income from continuing operations and then used to find the net income. Finally, the net income is how much total profit the company made. And so this is pretty much just a sense of how well the company is doing. You want to look for growth in the profits of the company and all of that. And so that's just at the end, after all expenses are paid, after all taxes are paid, after everything is paid, how much money the company is left over. And then net income attributable to shareholders is pretty much the same thing as net income, but they take out any income that's attributable to non-controlling interests. So this is normally pretty small. If you see that there is a large number for income attributable to non-controlling interests, you could look into this and just see who that person is or that other company is that is a non-controlling interest. But generally, the income attributable to the shareholders is very similar to the net income of the company. Thank you for watching. Please remember to like and subscribe.